Good day, everyone. Welcome to another video lecture for Intermediate Accounting 2. I am your instructor, Ms. Jazel May Celerinos Del Monte. So our topic for this video is continuation for bonds payable. So with this video, we are going to start with the bond refunding. So what is bond refunding? It is the floating of new bonds, the proceeds from which are used in paying the original bonds. Simply stated, bond refunding is a premature retirement of the old bonds by means of issuing new bonds. Bond refunding is also known as the bond refinancing. Now, in our own term, somehow we called it as renewal. Okay? Kumbaga sa ato pa mga personal nga utang, usahay mag-renew ta sa ato ang mga previous or ato ang current na utang. So what will happen with that renewal? So may tabo, the existing loan will be extinguished, and then it will be extinguished by paying or by establishing a new debt or new loan. So inana po daw ang bond refunding. So an existing bond will be extinguished, and then it will be exchanged into another bond, in another issuance of bond. Now there are two ways to refund the bond that could be done on or before the maturity date. Okay, so when the bonds are refunded or are made on the date of maturity, then there's no accounting problem, as this would simply call for the cancellation of the bond of the old bond liability. Then there is no more unamortized premium or discount involved. The retirement is handled in the usual manner, and the new bond issue is recorded in the new or in the normal way. Now, the accounting problem will arise when the refunding is made prior to the maturity date of the old bonds. Okay, so what will be the process of accounting for bond refunding made prior to the maturity date? Now, if you can still remember, with the retirement of bonds made before the maturity, there will be the same or similar process for the bond refunding. So what will happen? When you're going to refund or bond, when you're going to have bond refunding, now the process will start with the updating of the amortization of the either bond premium or bond discount, and after that, using the amortization, the updated amortization, we can get the balance of any unamortized premium or discount, and after that, we use the unamortized premium or discount in getting the carrying amount of the bonds refunded. And after that one, we will compare the carrying amount of the bond refunded into its refunding price, okay, or the redemption price niya, and then whatever the difference will be recognized as gain or loss on extinguishment of a financial liability. So that is how we extinguish or we cancel the existing bond liability, and after canceling the old liability, then a new liability will be established. Accordingly, the refunding charges are charged to loss on extinguishment. So if there are, aside sa mga redemption prices, okay, aside sa redemption prices, if there are other refunding charges, then that refunding charges will be charged to or additional loss on extinguishment. Okay, say for example, an issuance of new 10-year, 10% bonds with face amount of 1.5 million for 1.6 million. So this is the new bond to be issued, while the existing bond will be refunded. Okay, refunding of old 12% bonds with remaining life of 4 years at 102. So 102 is the redemption price. Okay, wherein the bonds payable face amount is 1 million, discount on bonds payable 30,000. So this is already updated. Okay, so this is already the updated unamortized discount on bonds payable. Now, if in case nga dili pa siya updated, then you need to update the amortization. Retirement price is 1,020,000. That is 102% of the face amount. So here in the computation, okay, let's proceed with the next slide. So there will be loss of 50,000. Okay, so loss of 50,000, that is composed of the unamortized discount, 30,000, and then redemption premium. What do you mean by redemption premium? The redemption premium is the excess of the redemption price over the face value niya. So if the redemption price is 102%, then the face amount is equivalent to 100%, then the redemption premium is 2%. So redemption premium and unamortized discount will compose the total refunding charges. Now, what if unamortized premium siya instead nga discount? So unamortized discount will be a negative or a deduction of the refunding charges. So kung kuan ni siya, kung unamortized premium ni siya, then this is minus. So if this if premium siya, minus siya, no. So negative 30 plus 20, so there will be a negative refunding charges nga 50,000. So since negative man ang refunding charges, then that is not a loss. Instead, that is a gain. Or another way to compute for the loss on extinguishment or the total refunding charges is that you will go through the carrying amount versus the retirement price. Now, the carrying amount is 970,000. That is bonds payable at par value or at face value less discount on bonds payable, 30,000. So, carrying amount is 970,000 less retirement price nga 1,020,000. So, the difference is 50,000. Now, loss siya, it is because you pay more than what is intended to. Okay, you pay a higher price compared sa imuhang carrying amount sa liability. So lugi gyud ka. So that is loss on extinguishment. So to record this one, to record the retirement of the old bonds payable, so i-cancel nato ang bonds payable at face amount, 1 million, and then debit the loss on extinguishment of bonds, 50,000. Credit cash equal to the retirement price, 1,020,000, and credit or cancel the discount on bonds payable, 30,000. And to record the issuance of the new bonds payable, debit cash, 1,600,000, credit bonds payable at 1.5 million, which is the face value, and any excess of the issuance price over the face value of the bond will be credited to premium on bonds payable. So, credit premium on bonds payable at 100,000. So, that is for the bond refunding. Now, in the subsequent periods after the issuance of the bonds, if there are bond premium or discount, such premium or discount should be amortized over the maturity period. Now, there are 3 approaches in amortizing bond premium or bond discount. These are the straight line method. When say straight line method, uniform siya every period. I-divide lang nato siya over its maturity period. Bond outstanding method and effective interest method, or simply interest method, or the scientific method. Now, in this video lecture, we are going to discuss the first 2 approaches, the straight line and the bond outstanding method. For the effective interest method, that will be a separate topic. So, straight line method, again, the procedure is simply to divide the amount of bond premium or discount by the life of the bonds to arrive at the periodic amortization. The life of the bonds is that period commencing on the date of sale of the bonds up to the maturity date. Now, this is very important, class. Take note that you will start to amortize, or the life of the bond will start at the date of the issuance, not on the date of the bonds. Na mag-iusahay, di ba? If you can still remember in our previous lecture na there are bonds that were issued between interest dates. So meaning after siya, that could be there could be a possibility that the bonds are issued after the date of the bonds. So pag ana, you will not count those period from the date of the bonds to the issuance of the bonds. Kundili, ang pag-amortize nato will start at the date of issuance of the bonds, or date of the sale of the bonds, up to the maturity date. So, simple lang kaayo ang straight line method. Dali lang kaayo siya. I-divide lang nato ang discount or premium sa remaining life niya, okay? Or the life of the bonds, and then that will be the periodic amortization. Now, next method is the bond outstanding method. Now, the bond outstanding method is applicable to serial bonds, whether issued at discount or premium. Okay, take note that the bond outstanding method will be applicable only for serial bonds. Again, when we say serial bonds, these are bonds with several maturity periods. In short, on an installment basis, or the principal are paid on an installment basis. Now, why is it applicable si bond outstanding method? Because bond outstanding method will be based on the decreasing outstanding balances of the bond. Okay? Okay, as the name implies, the bond outstanding amortization approach gives recognition to the diminishing balance of the bonds, or the decreasing outstanding balances of the bonds. It is based on the theory that interest expense shall decrease every year by reason of the decreasing principal bond liability. So, let's have the illustration. We have the face amount of the bonds, 5 million. The issue price is 5,300,000. So, issue price versus the face amount, there's a difference of 300,000. And that 300,000 is considered as a premium. Okay, mas dako man ang issue price kaysa sa face amount. Date of the bonds is January 1, 2020. And of course, the same pod ang iyahang date of issue on that day, January 1, 2020. Interest rate is 12%. Semi-annual interest dates are January 30 and December 31. Now, the bonds mature on every December 31 of each year at the rate of 1 million for 5 years. Okay, so every year, naga-mature daw siya every December 31, and then the entity will pay 1 million pesos every year. So, how to do the bond outstanding method? Now, first is you determine the periodic bond outstanding balance niya. And based on that bond outstanding balances, dira ta mag-create og ratio. And with that ratio, mo po na to i-multiply sa total premium. Okay? Premium on bonds payable to get the periodic amortization niya. So, say for example, for the first year, ang iyahang bond outstanding for the whole first year niya, 2020, outstanding pa ang balance nga 5 million. Though ang first payment happened on December 31, 2020, but still, for the whole period before its payment sa first year, December 31, 2020, 5 million pag yun ang iyahang balance. For 2021, na nagpayment man sa nagpayment sa December 30, 2020. So for the whole year 2021, the following year, ang bond outstanding na lang is 4 million. Similar with the subsequent periods, every year naga-decrease siya kay tungod na may payment nga 1 million every year. So for 2022, ang outstanding balance is 3 million. For 2023, 2 million. For 2024, 1 million. So for a total of, okay, you get to the total of these figures. Total is 15 million. Now, out of this bond outstanding balances and their total, you will create a fraction. Okay, you will establish a fraction. So, ang fraction sa 2020 is 5/15, 2021, 4/15, 2022, 3/15, 2023, 2/15, and 2024, 1/15. So, this fraction will be multiplied to the total premium on bonds payable. So, 5/15 for 2020 times 300,000, that is 100,000. So, meaning, the amortization of premium to be recognized for the year 2020 is 100,000. And then for 2021, 80,000, 2022, 60,000, 2023, 40,000, and 2024, 20,000. Now, if you get the total of this 5 amortization, it will total to the premium on bonds payable of 500,000. So, journal entries on January 1, 2020, of course, that is the issuance of the bonds. So, i-record nato, no? Debit cash, 5.3 million. Credit, okay, this should be credit class. Bonds payable, 5 million. Credit, premium on bonds payable, 300,000. For June 30, which is the interest payment, debit interest expense, and credit cash equal to the semi-annual interest niya, which is 300,000. For December 31, there will be 3 entries to be made. First is the interest payment. Second, the amortization of the premium. And the third is the principal payment. For the interest payment, entry, debit, interest expense, 300,000, and credit cash, 300,000. For the amortization, based on the bond outstanding method table, ang debit is premium on bonds payable, 100,000, and credit, interest expense, 100,000. And for the principal payment, debit bonds payable, 1 million, and credit cash, 1 million. Okay, the same lang ang process for 2021, mag-matter lang siya sa figures. For 2021, ang interest payment is ninggamay kay tungod the basis for the interest payment balance or the balance as the basis for the interest payment has decreased from 5 million. Nagbayad man og principal payments, so naimo na lang siyang 4 million. So, ninggamay siya. Instead nga 300,000, 240,000 na lang. Okay? So, that is for the bond outstanding method. Now, for the effective interest method, we are going to discuss that one on a separate video lecture. Okay. Now, let's proceed with the fair value option of measuring bonds payable. Okay. Now, the accounting for bonds payable will depend on the designation. If the bonds payable is designated at amortized cost, then as we have discussed in our previous lecture, naa siya premium or discount on bonds payable, wherein those premium and discount will be amortized. And as a result, we will come up with the carrying amount or the amortized cost of the bonds payable. Now here, fair value designation of the bonds, there is a different accounting procedure. Okay? So, kuan man to, di ba? Pwede siya at amortized cost at saka pwede po siya at fair value. Now, PFRS 9, paragraph 4.2.2 provides that at initial recognition, bonds payable may be irrevocably designated as fair value through profit or loss. In other words, under the fair value option, the bonds payable shall be measured initially at fair value and remeasured at every year end with any changes in fair value generally recognized in the profit or loss. Now, if you can still remember in our first part of the bonds payable video lecture, it says there that generally bonds payable shall be measured If not designated at fair value through profit or loss, it shall be measured at fair value less transaction cost. Kay kung ang bonds payable is designated at fair value through profit or loss, then the initial measurement will only be the fair value. Transaction cost shall be what? Shall be recognized as an expense immediately. Okay. So here, fair value option, again, the bonds shall be initially measured at fair value, and subsequently at every year end, we need to evaluate the accuracy of the fair value. So, kailangan siya i-remeasure. So, i-remeasure na to ang bonds payable with its fair value every year end, and any changes in the fair value shall be recognized in the profit or loss. There is no more amortization on bond discount and bond premium. Ano man? Initially, on the initial recognition of this bond at fair value option, there is no more discount or premium on bonds payable recognized. The amount reported, okay, the amount recognized as bonds payable is equal to the fair value. Now, if dili siya fair value option, di ba, usually, ang i-credit nato sa bonds payable is equal to the face value. Okay, sa face value niya. Pero pag fair value option, ang i-credit nato sa bonds payable is the fair value, not the face value. And as a result, there will be no more bond discount or bond premium. Again, any transaction cost or bond issue cost should be expensed immediately. Now, unsa lang man ang ma-appeal sa interest expense ani? Kung sa katong isa ka designation sa bonds payable which is at amortized cost, interest expense constitutes the cash payment plus or minus amortization of discount or premium. But here, under the fair value option, the only composition of the interest expense is the interest payment. Interest payment lang. Kay tungod, wala na may amortization of bond discount or bond premium. Say for example, on January 1, 2020, an entity issued with face amount of 5 million and 12% stated interest rate for 5,379,100. The bonds are sold to yield 10% interest. Interest is payable usually interest is payable annually on December 31. The entity paid bond issue cost of 100,000. On December 31, 2020, the fair value of the bonds is determined to be 5,300,000. The entity elected the fair value option of measuring the bonds payable. So entry on January 1, that will be the issuance of the bonds and the recognition of the transaction cost. Debit, cash, credit, bonds payable equal to the fair value on the date of issuance. 5,379,100. And another entry will be the recognition of the transaction cost into the profit or loss. So entry ta debit, transaction cost, credit, cash for 100,000. Now transaction cost is an expense to be reported in the profit or loss. Pag abot sa December 31, we will recognize the interest expense. So again, ang interest expense is based on the nominal interest rate or the interest payment. So pila man ang gibayaran nga interest. So that is equivalent to 12% annual rate of the face amount. 12% times 5 million, that is 600,000. So entry, debit, interest expense, and credit cash for 600,000. And lastly, at year end, if there are changes in the fair value, any changes in the fair value shall be recognized in the profit or loss. So what happened? On January 1, ang iyahang fair value is 5,379,100. Pag abot sa December 31, that should be 2020 class, 5,300,000 na siya. Ning decrease siya. So what is the effect on the decrease in the fair value? Is it a gain or a loss? Now, if we will internalize, when there is a decrease in the fair value of the bonds payable, that means there is a gain. Ginansya ka. Kay tungod, take note, bonds payable is a liability. Okay? Liability siya. So, kung nag-decrease ang imong liability, then of course, on your part, that is a gain. So, any decrease in the fair value of the bonds payable is a gain. Any increase in the fair value or ning sakay mong fair value sa payable, that is a loss. So, 79,100 ang imuhang gain from change in the fair value. So, entry, debit, bonds payable, credit, gain from change in the fair value for 79,100. Now, the change in the fair value recognized in the other comprehensive income. Now, some of the portion of the changes or change in the fair value might be, okay, recognized in the other comprehensive income and not on the profit or loss. So, under the standard, or the standard provides that the gain or loss on financial liability designated at fair value through profit or loss shall be accounted for as follows. So, first is change in the fair value attributable to the credit risk of the liability is recognized in the other comprehensive income. Now, if there is portion of the change in the fair value subjected to or attributable to a credit risk of the liability, that portion of the fair value shall be recognized in the other comprehensive income. And any remaining amount of the total change in the fair value shall be recognized in the profit or loss. What do you mean by credit risk? Credit risk is the risk that the issuer of the liability would cause a financial loss to the other party by failing to discharge the obligation. Credit risk does not include market risk such as interest risk, currency risk, and price risk. Okay, say for example, on January 1, 2020, an entity issued bonds payable with face amount of 5 million and 10% stated interest rate for 4.8 million. So it was issued for 4.8 million. The bonds have a 5-year term and interest is payable annually every December 31. The entity elected the fair value option in measuring the bonds payable. On December 31, 2020, the fair value of the bonds is 5.5 million. It is reliably determined that the fair value increase of 700,000 comprised of 200,000 attributable to the credit risk and 500,000 attributable to the change in the market interest rate. So, nag-state na siya nga katong total increase in the fair value of the bonds kay naay attributable to credit risk and change in the market interest rate. Now, katong attributable to credit risk shall be recognized in the other comprehensive income and the remainder shall be in the profit or loss. So, to record, on January 1, we will record the issuance of the bonds at fair value. So, debit, cash, and credit, bonds payable for 4.8 million. And on December 31, to record the payment of interest, debit, interest expense, 500,000, and credit, cash, 500,000. That is equal to 10% of 5 million. Now, for the recognition of the changes in the fair value, again, portion will be recognized in the other comprehensive income and the remainder will be in the profit or loss. So, entry, loss man siya, no? It is because there is an increase in the fair value. So, loss siya. So, debit loss on credit risk, OCI, 200,000. Debit loss from change in the fair value, which will be reported in the profit or loss, 500,000. And credit, bonds payable, 700,000. Again, the loss on credit risk is presented as component of the other comprehensive income, while the loss from change in the fair value is recognized in the profit or loss. Okay, so that ends our video lecture for this topic. So again, as a recap lang, bonds payable is a financial liability. Okay, so initial measurement will depend on the designation of the bonds. If it is at fair value option, then that will be initially measured at fair value. But if not designated at fair value through other comprehensive income, then the measurement is fair value less the transaction cost. Now, for further understanding of the lesson, you may refer to these following sources for your own referral. Okay? So, kung na may mga available nga books ani, you may refer more from these sources. So, if you have questions, you may if you have questions and clarifications, you may ask it directly through our GC. Now, thank you so much for watching this video. I hope that you have learned a lot from this video, and I hope that you are on a safe place. Okay? So, thank you so much, class. Have a good day. Bye.